right, welcome back to the channel. Another stock talk live stream / a reboot of Exit Liquidity 2.0 version 2.0. We got more people, better people, we'll say. So no shots fired. For those that don't know, Dan and I used to be regulars on Kingdom of Finance's channel, and we did an Exit Liquidity podcast. And after talking about it here and there, we thought it'd be kind of fun to get a weekly live stream going in somewhat of a similar format. So talk with some people, and we got Fabio from Capital Mindset and Bacon Memes from, we'll just say he's from the Discord world. He is lore.
I'm just a bunch
of course, we got Dan Weston from I think Dan, your channel is now Dan Weston, right? That's it. All right. Yep. Nice. So we got some interesting topics to discuss about today. If you guys can see my screen, let me know, because apparently it has issues.
Yeah, I was gonna say your camera feed just came in for the live. Yeah, I got like the YouTube channel pulled up on the super window.
What kind of production value is this shit?
Dude, it's called Trash Panda production value, okay?
What is your internet that I can short?
That would be Xfinity. Go for
it's already been priced in.
Go for it, because they suck. So
I literally would not move to another place if they didn't have FiOS. Like I told my real estate broker that. So whatever towns don't have FiOS contracts, I don't want any part of it.
I don't know if it is an internet issue. I feel like it could be an issue with StreamYard when I'm already I'm prepping beforehand and then we go live and it's kind of messed up. So, and then usually whenever I get the share done right away.
It's funny, when I got my driveway extended, I thought I had gotten the fiber optic line marked. So I'm like, all right, they're not going to hit it. I'm good. So I marked it. They do the bulldozer, comes up, rips like 6 wires out of the ground. I'm like, oh boy, that's not good. Everything dies in my house immediately.
Dang, that's definitely not good. All right, screen share looks good, just maybe bigified for the future, but yeah, we're good.
I don't even know if I can bigify it, man.
It's all good. We all do
try.
It.
Just zoom in to the window. You can't.
I might be able to, but we can get going at least with we got some YouTube drama around. We've got multiple things happening. So meet Kevin, privated all of his content. I don't know what's going on there. But that was kind of interesting. And then we got Dave Ramsey suggesting 8% safe withdrawal rates in retirement. And then we also have our favorite people, Paul over at Everything Money, getting margin called today, which is so ironic because I feel like most of us had really good days.
Some of us may not, yeah.
For
whatever reason.
Paulie boy apparently not so good of a day. So
the fact that he said it so like nonchalant, makes it me think that this happens like more than you think, because he was just like, oh yeah, I had to send some cash over and whatever, it's cool.
Do you know what? I think instead of like a traditional emergency savings, the man has like conflated the two and gone with like margin call savings.
He was probably like, oh yeah, I'll just put that out on my points credit card.
Yeah,
no problems.
So earlier this year, he was shorting QQQ.
Mm-hmm.
You know that.
NVIDIA.
He started shorting it like in the winter before it went crazy, and then he shorted Amazon in the past.
Yep.
I think he's shorting NVIDIA actually right now too. I think that's what he's got right now is NVIDIA. I'm pretty sure.
I feel like he has been short NVIDIA for like a while, I think.
Possibly. Didn't he also short the SPY in the past, or S&P 5? One of the S&P 500 indexes out there.
Definitely.
Sure. I mean, he's a short man. So.
Literally.
You think he'd be down to earth, but
Oh man, nothing is below him.
Something new I just found out today too. Burry closed his short on the QQQ.
Oh, did he?
Really?
I'm bringing receipts when I talked about that when he opened those positions. When I did,
yeah.
Yeah, he finally admitted defeat.
That's something that I don't get. Like, I would think you would, if you're playing with shorts, that you would have some type of stop loss, or like you'd have a specific level where you're like, hey, if I'm wrong, I'm wrong, and just cut it. But man, to dig in on short positions, that's so dangerous, so deadly.
Well, all that matters is just year to date, bro. So I'm not supposed to be year to date. Did you? What was it? I posted a screenshot from Twitter from a year to date, bro, the other day.
Oh yeah.
Yeah, you remember it? Yeah.
Yeah.
They're still in full force, and then the YouTube channels showing their year to date now.
Yeah.
Still doing it. 2022 never happened.
Good old year to date pros.
It's fine.
Yeah,
it's fine.
But keeping it to Paul. Okay, this is a guy that he can't even be a year to date bro. Like, he had a bad 2023. He's had a bad 2022. He's had a bad 2021. He's had a bad 2020. Like, he actually is so. It's so cringeworthily underperforming. Like, it's not like, oh, I'm underperforming. I'm putting all this work and I'm performing VU by like a couple percentage points. Like, Joseph Carlson, right? Not to drag him into this, but he's not doing that. Or where his volatility is like way outpacing the market. He is just straight up buying utter trash. And when he says, and he says this a lot back in the day when he first started the channel, talking about how, well, when the bad times come, then I'll be the one laughing. The bad times came and he got wrecked like just as equally, if not more. So it's I don't even know what to even put to him, because it's like he's so arrogantly stupid. Like, he is in the same, I guess, criteria or the same level as like a Jeremy Financial Education. He's up there, but he thinks he's above them. So I've been quite frustrated with him lately, because people will send me clips and I'll watch it. Like, Cole, if he's watching right now, you incessantly sent me the clips today for me to watch and time stamped it and everything for me. And then I was just like, why? I try not to watch these guys. But and then I told Jesse and company, we got to talk about this today. We got to add it to the rant, because I don't know, I just got to get off my chest. Like, this guy is a piece of work. He's too funny. And I see the comments rebelling against him now. Finally, people saying, at least Mo, they're saying Mo's clueless. Paul, some people saying like, I've invested in everything you guys said and I'm down a lot. Like, I invested in Walgreens Boots Alliance, a conservative value play. I'm down 50%. I invested in Bob. First of all, that person should not be following anyone on YouTube. But I'm just taking that comment to also point out and remind myself that I don't think they've actually had a single winner at all.
They might try to claim Meta.
They better not claim Meta, because we were there when it was written. And I remember them buying Meta in the 200s quite a bit.
Yeah.
And they stopped talking about stocks when they go down a lot.
Yeah.
Oh yeah. Intel, I mean, come on.
It really makes you wonder, because Jeremy's shtick was slap a 30 PE on it. Shout out to Dan, your video, or your intro video.
Wonderful intro.
Yeah, and then there's the everything money method of slap a 12, 14, 16 PE.
12, 14, 16?
Yeah. I'll have to ask Strongman if I can use that intro, because technically it's been gifted to him.
Yeah, just it makes you wonder. Like,
I don't think I have.
I was actually
30 on. Honestly,
sometimes 12, 14, 16 is a little too much.
I'll bring out my growth to P ratio chart. That's what I'll slap on you if you want.
I was actually thinking about that today. Like, a lot of these, I don't know, YouTubers and people that look at the historical like Schiller PE ratio, and they're like, well, it was so low back then, like everything's just expensive now. And there's like if you had to create a metric for like historically tracking relative valuation of equities against the market, like it would have to be a lot more complicated than a PE ratio. It would have to have some type of like risk-free rate adjustment within it, along with accountants for debt. So maybe a EV to earnings or something like that. Like there's a way that you could probably do it, but people that just look at historical PE ratios, I'm like, you're missing so much, like so much. Because I wonder, like in the 1960s, I wonder how many companies or I wonder what the debt level was of the, let's say the top 30 or 40% weighted of the index in the S&P 500 in the 60s versus now, right? And it's stuff like, a PE ratio is not going to show you a lot of nuance behind kind of a relative valuation of equity throughout a historical period. Yeah, I don't know. Rant over. Like,
are we referring to Paul's measure of the S&P 500 PE ratio?
Yeah. The Buffett indicator.
Yeah. Or even the Buffett indicator. That's another one that I think is like, I mean, unfortunately, like it's flawed, but for another reason.
Yeah, doesn't account at all the reality of current modern businesses, especially at the top end of the S&P. They're global businesses. You'd have to take more of a weighted global GDP measure and apply it that way. But
exactly.
he's the Michael Jordan of investing, so he's just way smarter. His underperformance is on purpose. Like we're just not seeing it. He'll be laughing in the end.
Like,
yeah. It's all part of the plan. Just trust it. The margin call.
It's fine. It's fine.
It's all fine. Just trust in the process. Trust in the process.
to me though, like that whole thing though, just like reeks of like I part of me wants to say if you really care about like expenses, for example, paying for a subscription or expense ratios, if you're that type of ETF bro or like index bro, is instead of like Vanguard with extra fees or extra steps, this is like Greenblatt with extra steps and extra fees. Because like instead of using their model, Greenblatt already gives you like a methodology very, very similar, spits out some companies at you that are either value or value trappish. And if you want to be a picker, then maybe you could use that as like a screener of sorts. But
yeah,
I don't know.
Yeah. Yeah.
So,
but hey, he's got the 8 businesses or whatever upstairs, right?
Oh,
so it's
yeah.
all right.
Yeah. Paul's like Disney Plus for his dad's businesses. All the money in it, from all the profitable stuff.
Land and expand.
Yeah, I mean that's the other thing. It's not even his businesses. There's nothing he can really point to besides everything money that he started, and everything money at the end of the day is a sham. Like Mo is actually a complete charlatan. His trading, he has no idea about anything, and the people see it in the comment section. You just go through the comment section and you see that people notice that about Mo. He actually has surrounded himself with such incompetence because he wants yes men, and that shows like his own internal insecurities in his own home domestic life. So he probably just surrounds himself with constant incompetency, and probably because his older brother is the success story of the family, actually has some sort of actual educational background, is a lawyer apparently. Paul has nothing.
You guys watch.
Sorry, I'm digging into it really bad.
Gloves are off.
I got nothing.
Well, I'm at the point now with my current state life. It's like I'm not cancelable. I can now say whatever I want. I don't care.
Oh man, yeah, that's been a mess watching that disaster unfold. But do you guys have any
unfiltered person on the panel from here on out?
Go for it. This is a safe space. Okay, Fabio, you can. We won't even ask you stock questions. You can just like rant about whatever you want to.
I feel like I need to save all the Paul material now in case he tries to delete it for a future special. Because I'm gonna get him.
Maybe he'll private it and make a video about farmers.
Well, I want to rant about me, Kevin, next because I just want to get it off my chest.
Oh dear God.
I was gonna let Dan go first on that one, but yeah, let's hit it.
Flip a coin.
Well,
I just want to add that one point, but
I'm probably the longest serving person that ever followed Meet Kevin because it was like literally from the beginning. I saw the whole transformation into the monster he became, and it's just I was trying to give light to that more than the current. Like you can, I don't think it brings a lot to the table to talk about all the crappy stocks that he selected because I'll be like, that doesn't really shed light on who he was. But that panic selling was like, and then the fact that he just totally lied about it to Echoes, and you can just see it, like the deception, and he's just a monster. I do think he's going to get in trouble. The way he's going to, it's either going to be some sort of tax issue or he's going to get in trouble by the fact that he's listed as the full-time or only employee of all these different businesses. And some investor is going to be like, well, how much time your filing said that you were like the only full-time employee? How much time did you spend on my investment? I think he might get in trouble for that at some point, but it's just strange. I think I didn't want to bring this up in the call. Like, I think it eats away. Like I'm religious to some degree, but I think it eats away at his soul that he knows what he is. And I think that's why he's an alcoholic and he admitted having rampant anxiety. I think it eats at him every day that he knows what he is. So like, I can't explain it, but like just those comments to Echoes during those streams. And he's like, he was like, he's always worried is what it sounded like.
Yeah.
He's probably like always thinking I'm going to get exposed at some point or the house of cards is going to fall in.
Imposter syndrome of sorts.
Yeah.
I mean, it's pretty sad, honestly.
I was shocked how little he makes off that ETF. When I actually ran the numbers, he makes like dog shit running that ETF.
What is it?
It's a vanity project. That's all that was a vanity project for him to put to do the videos where he was, hitting the mallet and put his sign out front. I'm sure it cost him money. I don't think he's made any money on that thing. So
how much does he make? Did you from your
0.02% expense ratio?
I don't think I thought it was like 0.2% or something like that. I don't know.
0 point.
I don't think
even
even
though the
covers
AUM.
like legal costs.
Well, Title gets a big chunk of it, I'm sure.
Yeah,
but, that's what his management company gets out of it. I found.
It's so funny because he's like talking about like pivoting away from like just doing news stuff, and I'm like, man, like you've got the money machine just going. Like, why not just be like, yeah, I'm just gonna do news stuff. Like, cool. Like
it could have been Value Tax because him and Value Tax essentially started doing the same thing. They both started with Stimmy Check, political news. Yeah. Value Tax just kept doing it, and he's rampantly successful.
He could have milked that for tens of millions of dollars, and then just like been like, if you ever wanted to quit, you're like, okay, I'm done. Like sell the channel off. He could have done like like Meet Kevin News or something like that, and just
rode off into the sunset eventually.
Yeah, rode off into the sunset. It's very, very odd. I definitely think there's something more going on behind why he's doing this rebrand or whatever you want to call it. I don't know.
I don't know. I think is it safe to say that it's possibly a publicity stunt of sorts? The guy, privating all of his videos for like the vast majority.
No, I think he's actually just trying to do like a complete rebrand, get rid of all the filth that was back there, and now move on, start a new Meet Kevin, new stocks.
We got receipts though. I've got some of it.
You got receipts, but the vast majority of people who he'll address on YouTube won't see that video, unfortunately.
No.
Yeah.
Because the algorithm just won't push you. It'll push you slowly, and he'll still be able to benefit from all that exposure. And just those videos not being there awards him that fresh start. But you do have the receipts, and you can continue to make videos, which recommend you keep doing. And in fact, those new people that he brings on then might see your thumbnail with his face on it, go to it, see the receipts, and go, oh, and you might gain more subscribers that way, more fans. So
just makes me wonder though, like the guy, like most of the criticism I think has been around what his stock picking and his over the topness when it comes to, you know, things not related to real estate and whatnot. Am I correct in that or no?
Well, can I just say, because I pointed this out in the call the other day, right, Dan? Remember, he also mistimed not just stocks. He sold his real estate.
Oh,
yeah.
Like
so I think I remembered more of it when you said that, because I was like, if I remember, I think he was losing his ass on Tesla stock. So people were thinking that he got margin called on because I showed like he literally bought the top of Tesla when he came back into buying. So people were thinking he went too far because he was so excited about Giga Austin, and then he might got margin called, and he sold all his real estate. When I think that money he was planning to use for like the jet and to start the house hack crap.
Have you ever heard the phrase or the, like, call it words of wisdom, that it's super easy to make money, it's actually really hard just to keep it?
Yeah.
I'll meet Kevin. He made a lot of money. He made $40 million at one point in terms of net worth and stocks. As an omen to all of you, that's a lot of money.
Yep.
A lot of people here listening would retire off of that amount of money. You'd probably be lucky in your lifetime to get that amount of money, and he was able to turn that into 10 million very quickly. Very quickly. I want to say that takes skill, but a lot of people are capable of doing it.
Oh yeah.
In fact, one person that I know, and you guys know as well, they had you could say, thankfully they had, I think, a significant portion in index funds, but had it been their entire investments in the stocks, it would probably be a similar outcome. So
yikes.
Yeah. And in the case of 10 million is still enough to have a good retirement. Yeah, but he's going to turn that 10 million into not
5.
10 million. Yeah. That's the issue, because he doesn't really learn his lesson. So, but the thing is, he can have the spigot on, and he can keep. The thing is, it'll be so much wealth destruction. He'll probably still be fine, but he'll never reach his full potential because he's doing what he's doing. So
he'll just always have to grift. It's always going to be having to go back to that. In summary, it's easy to be right once. Everyone's probably going to be right once in their life. It's much harder to be right consistently.
Be right once, take the money right off into the sunset. Stop.
Oh man. All right.
And then now there's only Dave Ramsey.
Oh no.
There is Dave Ramsey. And you know what? If I let the YouTube algorithm control me, all I would be doing right now is making Dave Ramsey content. Because I think that is the best performing video I have ever had, hands down, without a question of a doubt. Like, it's just wild. I did it for kicks because I was like, this is madness. Like, who recommends an 8% safe withdrawal rate? So I had to just like put something out there for fun. And it's crazy. I can see how people, if they let the YouTube algorithm control them, they just get pivoted in whatever direction it takes them, right? If you just went with whatever popped off, oh man, before you know it, you're talking about SoFi every day.
Well, I know who you're talking about. Yeah.
Yeah. So no, but I posted a video on that premise of an 8% safe withdrawal rate, and it's absolutely like insane. I think you get like what was it? Yeah, like a 30 something.
Yeah.
Like your failure rate is like 70% or something like that.
Yeah.
It's insane. And like, I kind of get where he was coming from. I think he was more frustrated that the guy felt like I think he interpreted it that the caller that called in felt like he wasn't gonna like have enough or something like that. He was trying to help him, but like that's not the way to go about it. And I also hate that. Okay, for one, he ignores sequence of returns risk, and then he suggests funds that are more subjected to sequence of returns risk. Because his suggestions are all aggressive growth funds. So it's like you're ignoring the thing that's most critical when paired with the investment types that you're pushing. Like it's oh my gosh, it's maddening to me. So yeah, I don't know. I'm not gonna I won't go back over it again, but it is wild to see. And you notice this with Paul too. So Dave sometimes and Paul all the time, they'll argue from a place of an authoritative figure, and that authority is based off of something else they did in their life, right? That has no relevance to the topic that they're talking about right now. So Dave will be like, well, like look at all this stuff I built, and then I think he'll like brag about his like portfolio and stuff. And the dude's like 80% in hard asset like real estate. Like, come on. Yeah. Just because you're successful in like one area in life doesn't mean you have the answers to every single question regarding finances in multiple areas. And I see people kind of almost using certain areas of success to justify them being like right, or why you should listen to them. Like, Dave's older, so that's enough, right? Uncle Davey. But I don't know. Did you guys see that video that he posted? What do you think of it?
This one. I don't know who wants to go first on
I was going to let you go first.
Okay, yeah. Like, we talked about this like on Dan's live stream. To me, like his premise is not only faulty with that, but also with like averages, because we all like to think, oh, well, I'm an average person, averages should work, but averages can really hide some things. And to touch back with what you said, Jesse, like periodicity matters. Like if you're in your 20s or 30s and you experience a lost decade, so to speak, with pick your grown-up ETF or index fund or whatever the hell you want to go with, you can probably stomach that okay enough. But if you're right there and you're going to retire and God forbid, like something goes terrible, like I feel for you. Like the expression of like, hey, buy when there's blood in the streets. Well, if it's your blood in the streets, I can respect, the anguish that comes with this. So it's, to be so passe and blasé about all this said, a little bit of care is nice, I think. Yeah.
And there's always going to be like individual circumstances where, if you're recommending like somebody wants to slow down a little bit and take a little bit more time off, and they have the ability to easily get work and supplement their income or whatever, that's like one thing. But if you're recommending that and they're like, yeah, I'm done, like my earning years are behind them, I have to spend this amount and this amount is 8%, then like that is one very, very, very scary suggestion to make.
Yeah.
Yeah.
What did he not make the argument that was it that the person could not work? I didn't.
It was like almost even off topic for the reason that the person came in or called in. So the person was calling in. It sounded like the person wanted to see if it would be okay for them to like pause retirement investing and just go over to paying off their house.
Yeah.
Just funneling their cash flow towards that. And I think they had they were like 32, 33, something like that. And they had like 120 grand in retirement investing.
They were that young. And
yeah, they were that young, right? But then like he just mentioned, he's like basically like, oh yeah, I'm pretty much coast fire. Like if my investments grow by this amount, and then I get to this, and then he's just said something about the 4% rule, and Davy boy, like a dog on a toy, just went like totally changed directions and just like ripped into the 4% rule. Basically called people like he was like those Redditors in their mother's basement, blah 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 blah, and it's like, what? Like, it was wild, man. It was insane. It was crazy. Yeah. And then he was like, you can safely take out 8%. Safely.
Huh. Wow.
My investments get 12% a year. I can take out 8. That still gives me
4%.
Oh,
Yeah.
He gets 12% a year.
Yeah, because his natural counter is he has the right funds. So if you factor a 4% inflation rate, you pull out 8, your money basically stays in place. You're fine from his point of view. That's what he's arguing, Dave.
I would love for him to show that, especially because he's marketing those funds. I would love for him to show his personal returns.
He should,
because since he is actually charging, for that.
And he does. Okay, so let's go over here. Shoot. He does not actually give the direct advice. He gets commission for referring people out to, I don't know, advisors. But so his recommendation is growth in income, basically even split, 25% growth in income, 25% growth, 25% aggressive growth, which, can I say, like, how much overlap is that right there? And then 25% international. And he's like, no, like this breakdown, you'll get 12% a year. Easy.
I despise that categorization. I despise that about the industry. Growth and income, growth of aggressive growth. The answer should just always be aggressive growth. Grow as much as possible. It's like I say, I'm going to go up to Dan. Dan, do you want to make a little bit amount of money? Do you want to make a medium amount of money? Do you want to make a lot of money? And then he goes like, I want 25%, a little bit of money. I want 25% more money. And then I want to put 25% and make a lot of money. I just despise that categorization. So stupid.
You should see. So my kid's college 529. I'm in aggressive growth.
Yeah, what the fuck?
So you know what you would never get. Aggressive growth is 60% US index, 40% international index.
That's aggressive?
That's aggressive growth.
No,
that's like
the
VT,
new
isn't it?
60-40.
So it's VT. So
that's
yeah,
VT.
I'm in VT for my kid's 529. That's like I would love to go even more. I don't know. I guess what would you call it? Degenerate.
But
to have
this
all
more
US.
degen.
This is what I'm talking about. I hate that categorization. I hate that.
Yeah,
it's so dumb. It's worded
So then-
improperly. It's just summarizes it in a way that doesn't actually give you any information.
no.
Yeah.
The conservative one is like it's mostly bonds and bullshit. Like, I mean, you only got 18 years for your kid's college fund, so you should probably go pretty aggressive. Like,
if it's still the same funds that he used to recommend, I'm pretty sure they had like a 5% front load with like a 1.5% AUM fee yearly. It was disgusting. It's like I'd rather own like QQQ.
That's stupid. I don't like it.
Thank you, Dave. Thank you, Dave. Thank you, Dave.
Oh my gosh.
Yeah. So in summary, he may be older than us. I was thinking of something, but no.
Go leverage. Go leverage.
Uncle Davey's old. No. And we're just the Redditors in our basements, guys. Oh, okay, Dan. What do you got here?
I'll have you know we don't
ready?
have basements where I'm from. So
No.
Feast your eyes on this. Wait,
what is this? What is this?
The dividend monster. You could just do this and say 4% goes to hell. You got dividends. Look at this guy.
What the
EP,
fuck
is that
is this?
EPD?
Oh,
Hold
sorry.
on.
He's retired now. He's like a 40-year-old guy, and he's living off his dividends. So this is his portfolio update. He does it on Twitter. So
Is that just yield
QQQX?
chasing essentially?
what? So it's just a lot of income funds and closed income funds. So I love it. I love following him.
Annual, good God.
A lot of these are utility based.
Good God.
Yeah.
Funds. It's
Do you have
wild.
I was trying to mentally add up all these numbers. What's the total market value
of his portfolio he doesn't share.
Oh, I thought
Oh,
that's what this is.
that's
showing.
No, this is his.
Oh,
this
that's
is his dividends.
Yeah.
Well, you could break it out.
Or no,
wait,
that is holdings. I'm sorry. He's got the
No, that's
holdings here.
holdings.
Yeah, he has another one where it's the dividends. He's making 6,000 a month in dividend.
Okay, I was gonna say because that can't be the dividends because then just the top two would be near the annual dividend amount. No. So you basically could add this up, but like roughly speaking, that's call it 60.
I think $500,000.
Oh, man,
Math is hard.
It just.
I'll say you could do it the other way. You don't have to worry about Dave Ramsey's 4 and 8%. You just go all dividends like I am, and you never got to worry about it. You don't have to pull 4% out of here.
Just live off the dividends. It's that
The dividends
it's that easy,
grow responsibly. So.
This is a lot of funds, though.
Yeah, I know. Well, this is just full-time job now is to man this. So.
Just buy SPY until you have so much that you can live off of the dividends and you never have to worry about it again.
Yeah.
Yeah, I just for fun would go through some of these.
A 1.5% withdrawal rate.
It's like I have like so much content with ETF reviews. There are more ETFs than stocks. Like
Yes.
I could really just pump out ETF reviews forever.
Yeah.
Like I have more research. My pool is greater than you individual pickers.
All right.
That's where the real content gold mine is.
Let's get into CPI. I didn't even know CPI was coming out today, and the market mooned, so it must have been really good, right? So we saw a little bit of a downtick. I think it came in, was it like 0.2 or point? I don't know. It came in like, was it 0.2 month over month instead of 0.3 expected or something like that? So it was below expectations, which is good regarding inflation. But so the thing that I thought was interesting was I started just poking around CPI. And
I think screen share might be a little scuffed.
Scuffed
black
right now.
Yeah, it's all black.
Oh my gosh. I'm sorry, guys. Let's see. So we're going to present this again. I wonder.
These things happen.
It does.
It's okay.
Share screen.
Honks Goose is pulling for us.
Thank you.
Yep.
Let's see if we got that. Is that good?
Yep.
All right. So, no, I think the narrative in a lot of our groups has been that like inflation is going to cool off. We're probably going to normalize. The Fed's probably going to follow. We could see a retraction in interest rates because of that. Now, what I thought was interesting was as I was looking into this inflation data, we see we've got all items here, and then we have all items less food and energy. And that is, I think, all items less food and energy is used more as kind of the baseline, just taking out those volatile sectors. But then I started looking at shelter, and it's still pretty dang high. Shelter's pretty dang high. I don't know about you guys. I don't know how about your view on shelter expenses coming back down, but I'm starting to see a lot of softening in my local market as far as home prices. And what I saw kind of in other time frames is that shelter typically seems to lag and could potentially be an indicator of like, if this is just the start of shelter going down, we could see CPI dropping pretty drastically over the coming like 16 months or so.
Do you guys recall a live stream I had earlier this year about inflation being primarily shelter? A lot of it was contributed by shelter.
I was just going to get to that. So,
okay.
If you look at the weightings for shelter,
this is the one.
So I might just be regurgitating info you already went over, but if you look at the weightings, shelter is 34% of the weighting for CPI.
Yep.
And then if you're just going off of less food and energy, all items less food and energy is about 80%. That makes shelter about 43% of the CPI index.
Mm-hmm.
Right? So yeah. So if this is just the start of a turnover in shelter, look out, because I feel like we could have a long ways to go.
This was also the picture here that you could also draw. So put it like this. I'll explain in a way like as an example that people can relate to. So let's say your housing costs increase. For some of you, you're mortgaging your home, so your housing costs aren't not increasing beyond property tax and maybe property insurance because your mortgage is maybe at a fixed rate. So that at least is not changing. But let's say you're renting and your housing costs continue to increase year in and year out. You're experiencing that level of inflation. That would you disagree with the following statement that now you have less money in your pocket for each and every month here on out? Because let's say if your housing costs increased faster than your wages did, would you agree or disagree with that statement? And then I'll move on from there.
Depends on how much of the previous wages have been thrown into JEPI.
No, okay. I'll take it as yes, you have less money.
Yes, you have less money.
So if that is the case, now you have less money for discretionary. So what we should have been observing is that we should have seen changes in discretionary spend across different categories. And that should have been reflected by various companies that we follow. Did we see that? The answer is yes. We actually started seeing that in summer of 2022. We started to
look at that correlation. So this is just apparel. This is just apparel, but look at the correlation to the peak in housing and then the fall off in apparel.
Well, this is my mic drop.
But your mic is set up to.
It's not. So I grabbed this remote and I'm dropping it because yes, that would make entirely sense. So I would expect to observe a decline in consumption across other categories, and we should see a volume decline. Maybe not necessarily a price decline, but a volume decline. And we should also observe this to be more sensitive in lower income groups that tend to be renters. And what retailer has been shouting for the past 2 quarters that they cannot increase prices anymore?
No, specifically 2.
One. There's one retailer that I follow, you follow. I think so. I think 2 of us have shares in this company.
Dollar General.
Dollar General. Dollar General past 2 quarters has been saying we cannot pass price increases to the consumer. They're tapped out. Who is the customer of Dollar General? Average income about $40,000, more likely to be a renter, therefore more variability in home expense. Homeowners in the middle class and upper class won't experience that same level of differences, and also tend to be higher income earners, which have experienced lesser broads of inflation. We are observing, or people are questioning, the slowdown in consumption narrative because and a lot of the things we're observing is mainly consumed by that group, which is still quite large in the United States. The United States is blessed to have a very large, moderately affluent middle class versus a lot of the world, relatively speaking. So the United States is very blessed in that. But those cracks have been showing for quite some time. So it's very interesting now to observe that as housing starts to cool off, well, that's, I think, a good thing. First of all, and then we've already been observing other cases. But depending on what market you're in, mind you, because I like that Jesse said his market is mellowing out. My market is not.
Well, aren't you fancy?
No. It's bad for the people.
Not our fault you live in a woke state.
Oh, man.
There goes the moving bus.
Hey, when interest rates were low, my house was on paper very, very, very valuable.
Hey,
I literally get letters every other day from real estate agents like, we want to buy your house, call us.
Yeah.
well,
Oh, did he freeze?
Uh-oh.
who froze? Oh,
Jesse
Jesse.
froze.
Me?
He froze out a smile though.
Gosh.
Yeah.
Do not worry.
Good
It looks
timing.
good. Like, it's actually a good look.
Yep.
It's
Oh,
not-
come
it's not a bad
on.
look. Like, look, it's like a permanent smile.
Can you guys hear me?
Yeah, we
hear
can
you.
at least hear you. Yeah.
Okay. Jeez, man.
But
This
makes
may
sense,
be the
really.
time then for my real estate trade or the retail
Ooh.
trade. Going for the retail, maybe.
Which I was gonna say, this led me to, the way that I've been playing potentially the decrease in interest rates has been with REITs. And in this type of a situation, we already see, just from today, we saw a little bit pullback in yields on the like 2 and 10. But if we continue to see the short end starting to decline and CPI rolling over, that leads me to believe it's just a matter of time until the Fed follows. What was that?
I was gonna ask, can you do me a favor? Can you get the Delta 2 10-year up when you get the chance from Fred database?
Yeah.
Good old Fred.
And then also the interesting with REITs is that not only are, well, with the market in general, not only are the short-term rates going to affect the relative risk-free rate that you do your evaluations based off of, but also for REITs and other equities that might be debt heavy, a decline in interest rates will potentially de-risk the the long-term negative effects of higher interest rates on their debt load. So you could almost have a double whammy of valuation re-rating along with risk decreasing.
Correct.
Solvency.
Fabio, are you just looking for the 10-2?
Yes, 10-2. And then we can look at that because I have a feeling that something's happening. I haven't checked in a while. Oh, yes. So zoom into more recent period. Okay, it appears we're uninverting.
Yep.
Uh-oh.
We're getting close.
So this is what I'm observing. Go back to most of the previous recessions. You'll see this. It's pretty common knowledge here, but I'm just highlighting it to the audience. So inversions typically happen prior to observed recession.
Mm-hmm.
And so I keep trying to tell members of the Discord, some of you know who it is, and some of us are also telling them, so it's not just me, but because it's like repeating information. So the times when you start to observe the common data points of a clear-cut recession, it's already kind of too late to be prepping. And equities might have already reacted to that information prior, unless it's a black swan event. So some emergency, because remember that 2008, people need to remember this. 2008 was like not normal. That was actually potentially like the only time you'll see that in your life. That was actually crazy. Most recessions are what we call, let's call it normal, mild recessions, rolling recessions, but recessions nonetheless. And so, yeah, typically we correct the inversion, we exit the inversion, and then we have the observed recession. So as we begin to uninvert, what do you think happens next? So 2024 is likely going to be an observed, potentially 2025. So I'll give it the next 2 years. wouldn't be surprised that we have the observed effects of a recession. But that doesn't mean that we don't have signs or signals right now of rolling recession. So certain sectors are having declines, others are not. And unemployment seems to have held up strong, but that's an observation. An increase in unemployment is an observation you'll experience after you already know you're in recession. So,
which is
really
funny because with how they track recessions, by the time they declare a recession, it's possible that you're already coming out of the recession.
Boom, bingo. So the investing advice for everyone is don't worry about it.
just chill, guys.
Don't worry about it. Just go hunt for companies alike and buy them. And then don't worry about it.
It's 2 quarters of negative GDP for a recession, right?
Correct.
That's been the textbook, yeah.
We
actually already
6
entered that.
months of trailing data for a recession to be declared. But what if the market's looking forward 8-12 months? Right? So a lot of times I feel like what you see is like when the worst news hits, often that can be almost the bottom.
Yeah.
In some scenarios.
Correct. Yes. So
this is the equivalent of the guy that said I'm an idiot for SoFi, but when I was talking about the credit loss, for allowance for credit loss, and he's like, their delinquency rate is only like 0.4. So I'm like, well, you're living in the present, and I'm trying to project the future.
Correct. I have a whole live stream that was had a presentation on this, that I was giving about the historical bottoming of equities relative to recessions, and it was typically equities bottom 6 to 9 months before the bottom of the economic cycle.
So what?
So like basically people who are timing, and that's like on average, okay, it does vary, and so attempting to bottom it based off of that data, your success rate is going to be really low. And in fact, you might miss out on a lot of gains. That's what that means. You might miss out on a lot of gains waiting for the data to get better. So
what you're telling us is macro traders are shit.
Oh, no.
Traders. Okay, so a great question was asked me by Pharma Shill on Discord. He asked me, would you rather invest in a macro fund or a technicals trading fund? And I said to him, that's like asking me, do you like to lose money or do you like to lose money harder? I said that I would take the technical one because at least when I lose money, I want to lose money knowing I'm a degenerate, not pretending to not be a degenerate.
There goes the moving bus.
Hey, so, I said I can be the unfiltered person on the panel. That's what I said. You can't.
There's so many studies you can point to saying staying in cash long term is the best way to wreck your returns. Or margin called on shorting, but besides the point.
Guys, you just have to be long-term investors.
Yeah. I think I speak for all the people here. Santarelli? Yes, no?
I was actually going to bring that up, Bacon. I was like, hey, you know what? We're seeing a rollover. Maybe Bacon is getting to the Santa rally.
You know what's coming, though? No, the dividend stock rally is coming.
Oh,
I'm putting pendies. Because actually, if rates start going down, everyone's going to think they're going to keep going down, or the projections are going down, and everyone's going to think pile into dividend stocks that have been beat up a little bit.
But
what are dividend stocks?
We're back on the table.
What I will counter with is that I think that's going to happen. I think it's for a different reason, though. I think as rates are going down, most dividend funds and dividend stocks are going to be equities that have higher debt loads. And the market's going to be re-rating those debt loads on a lower risk. So you'll have natural tailwind to equity prices within those funds because you have lower perceived future risk from lower interest rates.
Congratulations. You have completed the bell curve meme.
For
Dan's argument, rates go down, dividend go burr. Jesse, rates will go down, and then you'll see a re-rating because all the dividend stocks have larger debt loads.
We're on both sides of it.
And meanwhile, I'm the average, just trying and hoping for Santorelli.
See, I don't have all the terms, but I get there anyways. So.
By the way, I'm joking, everybody. Like those that don't know, last year I memed around.
In both cases, we mooned.
Santorelli.
Right? So
Yeah.
no, no, but I have kind of been thinking. We've had 2023 has been the year of large cap tech, essentially, right? That's been the sector momentum in 2023 was tech.
Mm-hmm.
It makes me kind of curious about what is it going to be in 2024, and if we see this play out, maybe it is going to be market gains might be more catered to, like what me and Dan were talking about, the companies that are probably more dividend payers, larger debt loads getting re-rated, as well as small caps. That if it looks like we're getting, if the market thinks they can see the end, and we're coming into the coast being more clear, potentially a rally in small caps as well.
Yeah, I make Buddha saying it. I think it's going to be REITs, retail, and those are really the two, because those are also the sectors that I've rotated some capital into in 2023. I had no REIT exposure, virtually no REIT exposure in 2022, and I started building it back up in 2023. Discount retail, yeah, I didn't have any. Yeah, because Dollar Generals, I never owned Walmart, Target.
Hey, ASO, man, where you at?
Not for him.
Where you
I don't
at?
understand. It's not for me. That one's not for me.
Hey,
right. I'll give you that.
That one's not for me. I don't understand it.
Dollar General and Crocs. That's all in.
Well, I'm looking at building a position in Ulta Beauty.
Yeah, I've got a nice little story going in Ulta as well.
Oh, you don't like Academy Sports?
I don't understand it. That's. I won't swing at that one, but it could be a huge winner. Pun intended.
All I'm gonna say is bullish T-ball. That's it. That's the thesis.
T-ball.
Yeah.
I mean, like I
man.
like the part of the country ASO is located in. Which I guess
Look at you. You like the red states?
the
Sunbelt.
Sun Belt. Well, if you
Yeah.
just look at demographics, I want to be in retail companies in the places where people are moving demographically. And there's not so many companies in that area of like where they can grow substantially. It's all ASO is one, Tractor Supply, you could argue, is another. So
when I looked at ASO, just from the financials and the setup from the quantitative side, it kind of reminded me of Musa.
Are they a buyback story?
They're trading cheap. They've got good.
they had
cash
expansion
flow,
plans that
and
kind of put on hold.
I believe they have the ability to split that between buybacks and expansion.
But have they stated, hey, we're
actually-
doing buybacks?
Let's see. I thought they did, but maybe I might be just making things up here.
Julius Caesar might know, because I think JC has been in ASO for a bit.
Well, the other thing, Fabio thinks Amazon's just going to crush everything, and
Yeah,
I
they've been
I don't think
repurchasing
sports-
stock for 2 years now.
I don't think sports is something you can really buy online. I think people want to go see and like look at their fishing reels and try on their sneakers to go running.
Give things a shot.
Yeah, I think
Trust
it's
things out.
defensible.
Oh yeah,
Well, you can look at
that.
Dick's. Dick's has done quite well in their modernizing their stores. I would argue.
How's their stock performance been on the chart? Has it actually performed really well?
Dick's, yeah.
Oh no, not Dick's.
ASO.
Has the market been
ASO,
rewarding it?
since they went public, they've been really strong.
Yeah.
Okay, winners keep on winning. I know that. That's my
Yeah, that's it. But wait, guys, we have to buy the all-time high breakout.
Yeah,
Ouch.
yeah.
Ouch. Just shots.
Did you like my clip where he said that it was at the lows in July? Certain companies.
Oh no! Oh no!
If you are watching, my buddy, I will tell you that I am green on Paycom.
Oh no!
Love you, bro.
A certain someone, when I interviewed him, said that he thought the payroll companies had bottomed. You can timestamp the interview and go look at what they were at the time.
Oh no!
I miss him.
Just stray shots everywhere. Spray and pray.
You know, that's a video though. I really want
right here. I think right there. No, right?
I really want.
It was on the. I think it was on this rally right here, or right. I don't know.
No, right there. That was it. That's the interview time right there. That's when he said that to me. So.
If you liked it then, you're gonna love it now.
You'll love it now.
You will love it now. At half off. Man. Yeah. How are you feeling about the payroll companies? We already discussed it, but just have it on the live stream.
I'm very interested in them. I don't know. My big issue with specifically Paycom and Paylocity, going back over this time frame, I just thought they were priced for perfection. Pretty much any type of chink in the armor would send these guys potentially re-rating, and it happened. I think Paylocity might have an easier resumption to growth than Paycom. Paycom is going to be highly dependent on their new product. If that new product pays off, it could be really nice though. If they're able to get into some larger companies, I almost want to say Paycom, I feel like, has more downside risk, but also more upside risk. And Paylocity is probably going to be, I don't know, potentially less deviation across the scenarios I would give them. That doesn't mean that price wouldn't be as volatile or more volatile, because we've seen Paylocity be pretty dang volatile lately on kind of re-rating. But going back to interest rates, if we do see interest rates come down, that's going to be a headwind for these companies, because they are generating a nice little chunk of their growth over the last 2 years has been from interest on the cash, those cash held for customer accounts. And surprisingly, Paylocity, I think, has been benefiting from that more than Paycom, because they typically have a larger cash balance for their customers than Paycom.
No, certain someone is a little salty.
I mean,
I'm sorry,
you're all
Andrew.
just jealous you didn't buy ADP when I did. That's what I'm thinking.
ADP, man, ADP is solid.
ADP is a Mount Rushmore dividend stock. I love it. I'll probably never sell it.
What do you guys think about
all
the
I do is win
HCMs right now?
How do we think about what?
I would love to man, if they got to the right levels, I would love to just buy it and hold it long term, because I think I think they are going to have really good long term tailwinds.
When I worked at unemployment insurance, I did the tax side for the businesses. I used to process the Home Depot unemployment checks that would come in from ADP. So they were paying $4 million a quarter in unemployment. So it's pretty cool to hold the check for that much. I'm to Dan Churchill, no one will know.
No one will know.
You just open the all the mail, and all of a sudden you're like, wait, for what the fuck? That's a lot of money. There's a paper check too. I mean, the way they would do it.
Yeah.
So you own ADP?
Yes.
Nice.
That is what we call a Dan winner.
I mean,
you bought it on the recent pullback from all the payment companies?
Oh God, no.
You've had that a while, haven't you?
I've had it. Yeah.
Dan's like back in 2010. I bought all these companies.
Yeah.
This one was more something like 2015 or 16, maybe.
I respect you, Dan. Not just because like at least maybe it's recency bias, but like sure the trading on the fringes has worked out well enough so far, but like as far as your core holdings goes, you actually use the N, if that makes sense. Like you actually like let time compound.
Whoa, I don't say the N word. What are you talking about?
Oh, I mean like N as in like number of compounding periods, basically. So like
See, you all trash dividend investors.
Yeah.
Dividend investors have characteristics that you should all have as retail investors.
Yeah,
but I will say
we all gripe about they underperform this and that. But you know what? If you describe the characteristics of a good investor for a retail person,
yes,
we check the boxes on a lot of those trades. And
you're a special dividend.
If you gave me
you're actually a good dividend investor.
And you guys compare like the S&P 500 to a dividend guy who owns like 40 individual stocks. Like, okay, why don't you compare that guy to a random person with 40 individual stocks?
Yeah.
Because I bet you he held them longer and he bought when it went red, and I bet you he's crushing it. And the other guy's out of the markets like ape fodder, right?
Ouch! Ouch! Everyone just getting sprayed and preyed upon.
I'll spray on everyone. I've seen some degenerate shit in
yeah,
stock portfolios, and I'm just like, you should have probably been a dividend investor or bought somewhere.
Yeah.
Wasn't there a comment you wanted to share?
Comment?
There was a comment I think you told us about that you said you wanted to share it today.
You want to? Okay. I did not tell either of you you want to see it.
I have no idea what it is.
It's not that shocking. Okay, let me share my screen. I'd rather show you.
I'm going to react to this.
All right, I'm going to share it, okay?
My favorite part is when people say stupid ass shit in the comments. I like to respond. I should probably stop this. But okay, so it was a comment for this one. Do you know this photo, anybody? It's a really famous photo. So these were surfers. They were surfing this 100-foot wave part of some beach. They saw a wave coming in. This guy. So he saw a wave coming in. He's on the boat. So he decided, he's like, I have a better chance surviving this huge wave jumping out of the boat than staying in the boat. And this photo is like amazing. And then this other guy, he was debating the same thing. Like, am I better jumping in the ocean or staying on the boat with a wave coming? It's wild photo.
I love how it sells 40% of SoFi shares. That was the CFO, right?
This guy, the president of the bank, and then the chief risk officer. Then there was some other people that said but okay, this guy, his response was, the CEO is buying the stock, so it can't be that bad. So what are your thoughts on Noto buying when all his other executives were selling 40%?
Oh God. I remember Lordstown Motors having an interim the CEO that replaced the original founder CEO. And he bought a token position. We all know how that one turned out.
Because this is a common retail thing that when the CEO buys the stock, it's bullish.
And how much did he buy?
It always is. It was a tiny position. I'd have to pull up his filing.
Oh, at Jesse, certain person's asking to hop on. That'd be rhymes with Gondar.
He rhymes with Gondar?
Yeah, or rhymes with Andrew.
All right, 1 second.
Yep.
Let me get him on.
Yay.
Here we go.
Yep.
Yeah, it was a tiny position. 44,000.
I might have to jump off here soon, though, guys.
No.
We continue the stream
on my YouTube channel.
I'll just like put myself on mute, and you'll just the wall. I'm frozen anyway. You guys don't even know. Like,
so the president of the bank sells half his shares, and then Noto jumps in after and buys this tiny bit.
Yeah,
can't be.
Yeah, no one ever takes a look at the dollar amount in the amount of shares. You ever notice that?
Here, if we actually want to keep streaming, I can just throw on to Capital Mindset stream, and then we just do. If you guys want to do another hour, because usually anyway,
the after party.
The after party. Andrew, if you want
exit liquidity 3.0.
3.0.
Oh my gosh.
Or 2.5. Yeah.
Got everybody.
What's up, guys?
The more faces, the more talking heads, the more bears.
Oh my gosh.
There's your indicator, everyone. I'm joking.
I'm trying to think.
So what we do is we start doing this.
Fellow Paycom
And then we
holder,
start just
how are you doing
just
today?
that. Start talking over each other.
Yes. Yes.
All right, sorry. Go.
Next thing you know, like we can just become a podcast, and then we'll just like believe in Bitcoin because line goes up, and we'll buy Enphase and
we'll SPAC.
maybe some Tesla.
I bought Enphase because if you really think about it, what they're essentially doing is it's like the Chinese renminbi and the difference between yuan and renminbi and US dollar. It's the same thing as like Bitcoin. And if you think about it, microinverters, it's really just another form of value conservation.
Currency. Right.
It's another form of currency, and I think in the future people are going to be trading microinverters amongst each other.
Jesse tore down my meat Brittany.
It all comes back to energy. Bitcoin energy, Enphase energy, microinverters energy,
Tesla energy, Nvidia
energy,
and AI.
ARM is saving energy. It all comes back to energy.
And Paycom makes you work less, which makes you save energy
in the form of calories.
Exactly. It's still a form of energy.
Oh man.
No one.
So Andrew, did you have thoughts
on what? I have lots of thoughts on lots of things, but what specifically?
Let's go on Paycom Paylocity, man.
Oh well, I still think HCMs, like the market penetration for these guys is still relatively small, even in the US. I still hate Paycom's direction that they went in terms of the business decision to go up market and basically nix a lot of your down market, unless you're planning to re-enter the down market. But
I love the squeaky toy.
You hear the dog's toy?
Hey. Oh my god!
No, keep it.
I love stuff watching. I just hope that no one ever edits this out.
I want you to go on like Chit Chat Money and have that in the background. Speaking.
I didn't realize you guys could like hear it that clearly.
This is the greatest value add.
Your dog's having fun.
Yeah.
It's wholesome.
Mm-hmm.
All right, keep going. So you're saying HCMs have bottomed. Another person said that too. Famous last word. No.
I don't know if I said they bottomed. I don't think that was my
famous last words.
I never said they bottomed. First of all, first of all, regardless of them bottom, they can fall quite a bit more if we hit a recession rates cut.
They've topped.
Yes.
When you say fall a bit more, are we talking Spirit stock, Spirit Airlines?
Let me see.
I'm joking.
I mean, I think if you hit, depending on like a deep recession, you could see these. Like you could see. I don't know about Paycom because they fall a lot. So is Paylocity, but I could see Paylocity around 100 or sub 100 if we hit a recession.
Oof.
Yeah.
And yeah, I don't know. Did they rally today? I'm assuming everything rallied today.
They rallied
a little
mildly.
bit, but like kind of weak. Yeah.
Well, I would think it'd be weak if they think rates are dropping.
You know who was weak today that we haven't talked about yet, but I want to get to after Andrew's comment. So I was just remember to mention it.
Well, and I was going to say, because clearly today the rallying was all because of your alpha and nothing to do with the market. So like if Enphase went up today, alpha.
Oh, did you see the tweet?
Yeah.
Did you guys see my tweet?
Yeah, I did.
I was nice to the guy, so the guy actually liked my tweet.
I can understand though, like why Enphase, if they're rate sensitive, why they'd be rallying. But I think you need rates to fall a lot more than like I think even in a normalized rate environment, like we said, between 3% and 4%, which I think most rational people would say is where we're going to fall if we don't hit like a recession or anything. That's really normalized. I think even in that environment, that's tough for Enphase.
Yeah. I mean, Enphase is still going to have probably 3 quarters to churn through their inventory, and we don't even know what their steady state demand is going to be.
I also just don't get like, and it's very interesting to me because sorry, the dog got the ball stuck in someplace. Dude, no, there's nothing there. You're an idiot. It's right there, Tilly.
Yay, Tilly! Shout out Tilly.
Stuck balls is a problem in the Gondor
So anyways, this is why during the ICOMs I have the door shut, but it's like when it wasn't just hopping up. But anyways, I was gonna say I'm surprised that Enphase is a retail stock because it's like this cyclical, rate sensitive. Maybe I should have gotten on.
No, the people love this.
So anyways,
yeah.
Oh, so
man.
but I just don't get why retail is so heavy in Enphase. It's like having a massive, to me it's the same thing as like Tyson food. It's a cyclical, it's like highly sensitive to things outside of its control. Why is retail just dumping into this? Like, I get Tesla, at least. Tesla's just been like kind of a growth stock, and it just grows. Like, it has been growing kind of regardless of the macro environment, right? So like that kind of makes sense because they can point and say like, oh, it's going up. Enphase is like a cyclical stock, so I don't know.
I think Enphase could be really good long term, but like over the next like 3-4 quarters, I think it's gonna have a rough time. And I would want to like be very confident that I would want to be very confident in probably the 2-year pipeline of what type of demand they're gonna have, and see clear tailwinds to that with decent valuation before jumping into it. Like I was in it, and then I got out, and I'm like, I'm just gonna like let this one bake.
I also don't think that I don't think microinverters, like the actual microinverter itself, becoming a commodity is priced in Enphase either.
Oh wait, you're out, Jesse? With Enphase?
Yeah. Yeah. Well, you're wrong based on today's price, unless you sold today. My gosh, it was up 16% today?
Yeah.
No. Oh, it's down 70% year to date.
Year to date, bros. Quick again.
Wait. This is why.
I added up in like mid 70s, and I think I sold everything in. Yeah.
So that person tweeted, and then I tweeted that at them.
What's the math? If a stock falls 70%, what percentage do you have to make up to get back to even?
Isn't it 300 or something like that?
I want to say.
Oh wait, hold on. One more time.
If a stock falls 70%, what percentage gain do you need to make from that bottom to make back?
It's
I have a follow-up
more than
question.
70% naturally.
If stock falls 100%, how much do you have to gain to get back to your original?
It's more than that.
Your cost basis.
Yeah. If
so probably a couple million.
100%,
75%,
100%.
Big Pharma Show says 70%. Idiot.
Yeah, that's not how the math works. But
the Pharma Show, no. I hope you.
Yeah.
I'm reading it how I imagine his voice would say it. 70%. Pause. Idiot.
And then he says, "I'm dead."
I'm dead.
DED.
That's when you take the test and you're like, it can't be this easy. I need to think. Can I take the prediction test?
70%.
Pause.
How much do you need?
Is that the actual number?
Miquita
333?
Yes, 333.
Yeah, it's like it's a quadruple roughly.
Hey, I was close. I said 300, right? So
this is why there's that book. What's the book? I mean, I have it here. I read it. Art of Execution. Why it's why when Paylocity fell, I was like, I need to do something. I need to sell my position. I need to buy more. Now, but it only is down because I bought a little more. I think it's only down 25 to 30%, somewhere in there. But still, you have to make up a decent chunk to make that back.
Yup.
Oh, yeah.
If we're talking just break even, let alone
and that's the scary thing with companies that are growing at a 25-30% clip, and they're trading at a a PE of like 80 or 70 or whatever, is like, if it doesn't take much for them to be dead money for 5 years. Like,
and this is why
you can have some contraction, multiple re-rating, and then even if they just have a multiple re-rating sustained and they continue growing, like, you might not recover for like a long time, and that's with the business performing pretty well at the core. Like,
this is why I hate the cope of like, oh, this might be dead money for 5 years, but I know in 10 years it'll be a 5x. Like, okay, so buy it in 5 years, you dumbass. But like what it really is it's guys talking, they're just like hedging themselves because they don't want to say like because that way if it goes down, like, yeah, I know I said it'd be dead money for this amount of time, but like in 7 years now,
It's actually 233%. McBuddha says.
Yep. And censorship is not cool, Andrew. Your dog deserves to be heard.
Can you pick up your dog? Can we see your dog?
I can't pick her up, but Tilly, sit, Tilly. I'll show you, or I can.
We get to see
Yay.
Puppy.
Doggo.
Doggo.
Aww.
Yay, Tilly.
I mean, I could pick that dog up, just saying.
If every single viewer has not liked this live stream now, what's you hate dogs?
Yeah.
Some might say this live stream has gone to the dogs.
Let me actually, if you guys want, I can see if I can make her howl right now.
Oh, wait.
She's one of those dogs where if you get piano playing sometimes, if she's relaxed, she'll start howling.
Really?
Yeah, hold on, let me see if I can. I have to get her relaxed.
She's
So I
start
don't know if she's
playing the piano.
I'll just play it on the YouTube or something.
I was like, wait, he turns and there's like a grand piano there.
I'm like,
He's like, yeah, I'm actually a professional pianist.
Okay, Tilly, sit. Let's see if she'll do it.
Wait, what's with the
Got
piano?
really somber here.
Yeah. Is that Fabio? Fabio, I'm blaming that on you.
She does it for piano and ambulances. Oh, she might do it.
Oh, she's gonna narrate it to the music. The tears of bag holders.
I'll hold this up while we're waiting.
Did you not hear her?
Yeah, I heard. We heard that.
Okay. She does it. She'll do better if I get like, I don't know, just depending on her mood. But she's
Double
like kinda
dragon.
antsy. Anyways,
But yeah, the art of execution, really good book. Actually, I think link
I just
is
got
in
it.
the
Actually, I'm
description
gonna read it.
of this video. So, really good book. Especially after 2020, 2021, with a lot of the oh no, it was funny. It's funny some of the examples they drop. So
I know.
I highly recommend it.
I love when you start talking about the people that's like, oh, the stock goes down. They're just like, I'm all in the stock and I love it. I'm not gonna do anything. I'm just gonna sit here. I was like,
Yeah. And I don't know if Fabio and Andrew, if you were on when I said this, but I was comparing the value traps of growth investors are cyclical companies and fakes.
Oh, yeah.
Nvidia. Like,
or
man, when they normalize eventually, you better look out.
dude,
Look
Tesla.
out.
Hey, did you realize that Tesla's been dead money now for like what, 2 years?
Yeah.
But hey, it was dead money from like 2013 or so till 2019.
No, you know what this
You
means?
guys-
That's true. Actually,
Did you
is
guys
it
know
though?
I had Tesla?
Yeah,
Yeah,
I think you said that.
Yeah.
No, you're right.
So did
You probably made money on it though.
I bought it before
Oh,
the
no, I
first time it
did.
split. So
Very nice.
I bought it into the 2020 crash. My last shares I sold split adjusted at 333. Or actually it was a little bit over 1,000, so probably like 340.
I
Man,
sold it
boy.
like a week after it split, I think, the first time when I bought it.
I was gonna say,
former Tesla shareholders.
do you know
Yes.
that when I worked at Wells Fargo, we had this one guy. He must have been a Tesla insider because like Tesla, I think Tesla and Amazon were the only things he trades. So, like maybe he lived over in California. I never checked where he lived, but he had like a $500,000 to $1 million account, and he would just call in, and all he'd do is right before earnings, he's like, "Hey, short the entire thing on Tesla," and then Tesla have a bad earnings, and he called and say, "Okay, take off the short," and like he was right every single time, and I was like.
Hey man, watch what you say on my channel.
Tesla.
Andrew was like,
gotta take down this live stream now.
You know, the comment section of this live stream are going to be Tesla is I'm dead money. DED.
No, because he didn't just short. Like if he do both, he played on both sides. But like, it was just, I remember one time one of my friends was like, "Can we just copy his account?" I was like, "You do you, man, but I'm not gonna do that because the second it blows up."
Well, I will save my Cybertruck bashing for something else.
Yeah, well, it's coming up on an hour and a half. We should probably wrap it up here soon. But man, it's been fun. And Andrew, yeah, you're always welcome on if you want to chat. I think the standard time is gonna be Tuesdays at 5 p.m. PST. We're just gonna hang out, have fun, chat about markets and whatnot. So,
no, I mean, and it felt like my dog wanted to talk more this time, anyway. So,
oh man! All right, you guys got anything else?
no, that's pretty much it for me.
Did we still want to keep the live stream going?
Yeah. Is there a exit liquidity 3.0 coming on?
We can exit Liquidity 3.0. I usually use Tuesdays anyways for live streams, so
cool.
I got energy.
All right, well, if you guys are on, go check out Fabio's channel at Capital Mindset. Sounds like he's going to pick it up over there. And
I got a question.
On the next one.
Okay, Dan, we got a question.
No, not here. I'm gonna wait till we get to his channel.
Oh, Dex. Fabio can be entrance liquidity.
You can call it. What do we do that? Different parts? Exit liquidity,
entrance liquidity,
margin liquidity,
dried up liquidity.
No, margin text.
Yeah.
All right, guys. We'll catch you in the next one. Have a good one. See you next week.
See you guys.